Hello everyone and welcome to this accounts update for charities. Now in a way the title's a bit of a misnomer because it says update. There is nothing specific currently in the works to change for charities, so there's nothing that applies, for example, for 2023 year ends. The accounting standard which underpins the SORP is up for review, and the results of that review won't be known until the end of this year. Now, we know that the SORP Review Committee's work is ongoing and they will be looking at the output of that review of FRS 102. At the moment, what we do know is the new version of FRS 102 is unlikely to apply to accounting periods beginning before the 1st of January 25 at the earliest. So given a lot of charities are a March year end, that would be periods beginning 1st of April 2026 and therefore is the March 27 year end. The headline change proposed, which is potentially relevant to some charities, is the idea of bringing all leases onto the balance sheet. So that will be particularly relevant if you have a property lease. However, as that is not due to happen for another 3 years, we thought we would focus on the practicalities around annual accounts at the moment and some of the things to look out for. So we've headed this 10 common trip hazards in annual accounts. And by trip hazards, I mean things which are subjective and therefore need judgment, things where the trustees may lean on the finance team, and things that don't come up every year but are sufficiently regular that many charities do encounter them. And now we've divided this into 3 areas to talk about the numbers, then the words, and then some wider documentation considerations. So we'll start with the financial statements and the numbers first. And the first area I wanted to pick up on was grants. Now, of course, the rules governing how you account for a grant are different for charities compared to commercial companies. The focus is on the entitlement, not the receipt of cash. And the variability of grant documentation, even potentially when you're dealing with the same grant giver, means it's often unclear from an accounting perspective. So you have to look at the grant documentation quite thoroughly. Particularly challenging can be grants where there is a multi-year entitlement, because there are 2 different things to think about. One is restrictions. Now, of course, that's about how you use the grant, not when you recognise it. So that's to do with the classification in your reserves. But the second issue is the performance or the delivery you have to undertake to earn entitlement. And the question here is whether there are specific actions you have to undertake or whether you recognise over time. A particular challenge for charities is the fact that very often the recognition point for a multi-year grant does not coincide with when you incur the expenditure. So there's no matching of income with expenditure. Now, a key point to watch for with a multi-year grant is whether there is an approval hurdle to access monies beyond year 1. And if there is a hurdle, whether that hurdle is within the control of the charity or outside the charity's control. Now, what I mean by that is it's within your control if you are simply providing some information about progress. So all you've got to do is report back to your grant giver about what's going on, but the money will still continue to come through. So effectively there you will recognise all the income from the multi-year grant in one go at the outset. If it's outside the control of the charity, well, that would be, for example, where you are required to do a budget submission, and only when you have cleared that hurdle will the next tranche be released. So you're having to go back and provide further information for the grant provider to go through a further process. Now, I'm talking about this from the perspective of a charity receiving grants, but of course, if you're a charity that is giving multi-year grants, the same principles apply. it's really important to be clear about what you're expecting your grant applicants to do in order to unlock a further tranche, and whether it's something that's within their control or whether you are going to make a further decision about whether or not to give them year 2 and year 3. Now, if you're not sure about the grant arrangement that you are presented with, talk to your auditors at the outset. It avoids or minimises the risk of challenges post-year end, but it also means that management doesn't set up expectations with the trustees about the income that's coming through that then isn't borne out. And of course, a very important point with trustees is to make sure they understand the distinction between the income and expenditure profile and the cash flow profile related to any grant, because that's crucial to them understanding the charity's cash position. Moving on then, another potential challenging area, trip hazard, can be legacies. Now again, quick reminder, there are 3 tests to recognise a legacy. One is entitlement, and that's normally based around there being a valid will, a death having occurred, then probate. Probability, which is about the extent of the estate, the risk of claims, and things that impact on whether the charity is actually going to get the money. And then thirdly, being able to make a sufficiently accurate judgment of the amount you expect to receive. Now, obviously, if it's a specific bequest, that's a lot easier to assess than where you are the residuary beneficiary from a legacy and you've got to wait for everything else to be paid out. Now, it's never easy making assessments about probability and amount of legacy receipts. It depends on the information flow from the executors. It depends on how the solicitors, for example, manage their own risk. And there's often a natural preference for smoothing, especially if you have a particularly good year for income. So again, how can you avoid an unexpected challenge at the audit? Well, the first thing I'd say is make sure that your information about legacies is as up to date as possible, particularly at the year end, but also post year end, because money's coming in post year end where actually the executor made the decision pre-year end still need to be recognised as income for the year. So data is everything here. Secondly, be consistent in how you assess what are essentially similar situations. So what factors do you take into account when you're determining whether or not a legacy should be recognised? For example, is it looking at whether the property sale, if there's a property in the estate, has taken place? Is it when the estate accounts have been approved? Is it notice from the payer? Some charities take a more cautious approach than others, but the important thing is to be consistent year on year and not change your analysis, let's say, depending on other external factors. And the final thing is to make sure you explain your recognition policy clearly in your financial statements and how the trustees and management apply their judgment. And you can't do that explanation if you're not clear about the factors you take into account. Now, so far we've been talking about income, so I just want to jump to the expenses side and talk a bit about dilapidations. And this is relevant to any charity who rents a property for use by the charity. And the reason dilapidations are so important is because of the risk of unexpected cost to the charity if you lose sight of your obligations under the lease. And that could be a cash impact, which might not be at the ideal time for the charity's cash position, but also it's a hit on reserves. Now, one of the things to bear in mind about dilapidations is there are 3 potential obligation points around having a property lease. One obligation arises at the outset of the lease if you modify your premises and have an obligation to then restore them to their original condition at the end of the lease. Now, in that instance, you have to provide for the cost of restoration at the point you make the modifications. And the impact on your accounts is to record a provision, so a liability on your balance sheet, but also an increase in the cost of the asset. Effectively, the cost of restoration is treated as part of the asset, and that in turn is then dealt with in your income and expenditure account through depreciation. The second obligation point is one which just accrues over the period of the lease. So, for example, if you've got to replace all the carpets at the end of the lease, regardless of the state they're in, you would recognise the obligation for carpet replacement just on a time basis. The third obligation is as deterioration to the property occurs. So this is about a condition dilapidation. In terms of managing your obligation, it's important you understand the requirements of the lease at the outset. And if it's a condition obligation, that you do have a regular process for reviewing the condition of the premises, and you're planning for maintenance. So to some extent, you are spreading the actual cash cost by doing things as you go and minimising the work that will need to be done at the end. So a couple of sort of tangential points, therefore. What's your trustee skill set around property? Do you have anyone with property expertise? Because if your premises are significant, that would be a worthwhile skill to have within your trustee board. But also, are you making sure that your management information is tracking the position as regards your lease? Now, we've talked about income and expenditure, so let's move on and talk about the balance sheet for a moment. And obviously, grants and legacies and dilapidations may impact your debtors and creditors or provisions on your balance sheet. So what I wanted to pick up on was specifically fixed assets. And particularly understanding the status of your fixed or capital assets. So again, particularly we're talking about premises and related assets. First thing to understand is, are there restrictions on those assets or not? Now, if there are no restrictions, then clearly they're going to be part of your unrestricted asset reserves, and any depreciation is going to be charged to your unrestricted reserves as well. If there is a restriction in relation to a capital asset, the next thing to understand is whether that was a restriction on the funds or whether it was a restriction on the use of the asset. So as you see on the flowchart here, there is a distinction. If the funds have been restricted to the purchase of a specific asset, once you've made the purchase of that asset, the restriction comes to an end and you can transfer the funds into your unrestricted reserves, and your depreciation will therefore be an unrestricted item. But if the restriction effectively is the funds are to buy an asset which itself is to be used for a restricted purpose, then actually your fixed asset is a restricted asset. And what's really important here is you're doing regular reconciliations of your fixed asset register, and particularly the restricted capital assets, to your restricted capital reserves. And if it's a restricted asset in the sense that you can only use it for a restricted purpose, then the depreciation is also a restricted item, and that's going to impact on that restricted reserve. One other point I'd make on fixed assets is, do beware, there is a distinction between having designated some fundraising to be applied to buy particular assets and having had a restriction in the first place where there is a specific purpose for the fundraising. So remember, there is a choice here. The charity has raised some funds and the trustees decided to use it to buy a particular asset, as opposed to a fundraising campaign that was designed specifically to fund a particular asset. And I have seen charities get themselves tied in knots over whether assets were restricted funds or designated funds. Finally, on your financial statements, let's just think about some trip hazards in disclosure. Now, the analysis of items in the P&L and the balance sheet is usually fairly straightforward. It tends to be things which don't directly link to the analysis, which are a little bit more challenging, especially things around people. So in terms of people-based information, the first one I wanted to flag is the key management personnel. So you have to disclose where your key management personnel have total remuneration exceeding £60,000. excuse me, and you have to disclose the number of individuals in bands then of £10,000 above 60,000. So key things to watch out for. First of all, who are your key management personnel? And do keep that under review, because as a charity changes and perhaps as you build your leadership team, that may impact on who needs to fall within that heading. But also, please remember, when you're looking at the total of key management personnel remuneration, you have to include employers' national insurance. And there are charities who have not noticed they've tripped the 60k threshold because they've forgotten to include the employer's NI in that calculation. And some of you will be wondering, what about the pension contribution? That is excluded. So that's also a trip hazard. Don't put the pension costs in, but do include the employer's NI when you're working out what the total is. Another one to watch out for is severance or redundancy. This is often quite a sensitive subject, but there is a disclosure requirement around severance pay. So it's the total pay, the nature of the severance or the redundancy, and the charity's policy for dealing with that. The third one to watch out for is trustee expenses, and that's expenses reimbursed to trustees, where you have to disclose the amount and the number. So the point there is how well your records capture that data. And finally, related party transactions. Again, record keeping. Who are your related parties? What transactions have occurred? But please remember, you do have to give a negative disclosure if there are no related party transactions or balances in the year. So it's very important not to lose sight of that. Now, let's move on and talk about the narrative side, the annual report. And I just wanted to pick up a few quick points around risk reporting. The first one is that risk reporting in a trustee's annual report is not about your process of risk management. It's about the nature of the risks the charity faces. And it's really important that you focus on your principal risks. So this is not about regurgitating vast chunks of your risk register or even the first couple of pages of it. Really, you should be picking out the 3 or 4 key risks which currently are really of concern to the trustees and impact on the ability of the charity to operate. Try and make them as charity specific as possible, not generic. So explain why they are relevant to your charity, how it impacts on you, and what you're doing about it. And don't roll them over from one year to the next without thought. For example, you may have been talking quite a lot about the impact of COVID in your last couple of years' financial statements. That could still be relevant to your charity, but it's now going to be the consequences of COVID for your charity rather than how you're managing your response to the pandemic itself, because we're through the main impact of that. So topical issues to watch out for, staffing, particularly the availability of staff, competitiveness of salaries, especially when perhaps you're a charity that can't afford to pay a great deal and people feel that they can go and get well paid or better paid doing other jobs. The impact of the cost of living crisis, for example, on your donation pool, but also maybe on the availability of volunteers, perhaps for fundraising or for your charity shop. It might be because you are a medical-based charity and you are heavily linked to what's going on in the NHS in terms of resources or pay levels. Cybersecurity is a very important risk for charities at the moment as well. So is that something you perceive you have a particular vulnerability to, and what are you doing about it? Do describe the charity's response. And I'd normally sum these up as treat, tolerate, transfer, or terminate. So tolerate is, this is a risk we just have to put up with because there is not a lot we can do about it. It's external to us. Treat is going to be about how you mitigate that risk. Transfer might be insurance or might be sharing a collaboration with another charity to make the risk less significant. Terminate, of course, is we're going to stop doing that activity, or we're going to stop the particular circumstance that gives us exposure to that risk. And the final point is interaction with your wider commentary. Do your principal risks make sense in the context of what else you've said in your annual report? Is it clear why those are the risks that matter to your charity and how they link in with your reserves policy, for example, and your future plans? Now, I've mentioned reserves policies, so let's come on to those and the key things to watch out for in drafting a reserves policy. I think the first thing I'd say is don't treat this as just something for the annual report. Your reserves policy goes to the heart of how the charity sustains its activities. So when you're drafting a reserves policy, it's good practice to start with the big picture. Why do you need reserves? What's the overall composition of the reserves that you've got? And think about how you make that something that people can get their heads around easily. So, for example, do you want narrative, or would it be better to perhaps go for some sort of table or maybe a graphic like the pie chart on the slide there, as a way of getting a bit of impact across in terms of what your reserves are made up of? If you designate reserves, be clear over the purpose of that designation. Funders want to know why you're designating reserves. And do you explain how those designations have been used in practice? Funders will see through an attempt to underplay free reserves by designating things, especially if those designations don't change or move year on year, or just get bigger as the charity's overall reserve pool increases. When you talk about your free reserves, how do you characterise them? For example, do you include designated reserves? And if not, make sure that you are defining clearly why designated reserves are not part of your free reserves. And then what comprises your free reserves? For example, are your fixed assets included? If they are, which fixed assets? So if, for example, you have an investment portfolio, do you regard that as part of your free reserves and therefore there to fund the everyday activities of the charity? Or in fact, is that an element of reserves you don't want to touch? And it's the income from your investments, which is part of your free reserves. And finally, what's your target for reserves? And why do you have that target? How did the trustees choose that target? What way is it relevant to the charity? And where are you against that target? What are your plans to bring it into line? What's your time frame? So think about how you can make your reserves policy not just a section that has to go in the accounts, but something that really gives people a sense of how the charity plans and sustains itself and the factors that are being taken into account. Now, finally, on your annual report, governance and admin. It's the final section. It goes at the end. It's often seen as the dull stuff. Now, I'd just like to suggest that maybe it's an opportunity for the charity if you look at it through a slightly different lens. What's it like to be a trustee of your charity? So, does your governance and admin section communicate what we look for as a charity, the sort of people we need, how many we look for? How do we help you find your feet if you become a trustee in your charity, in our charity? What's it like being a trustee? What commitment do we need from you? So a sense of how often, for example, committees meet, how many committees you have, what's the time commitment, what do trustees do over and above committee meetings? What sort of activities are expected? And what's your attitude towards governance? For example, how do you plan for succession? What's your attitude towards charity trustee terms? How do you make sure that you are looking at the skill set of your trustees? How do you make sure that you've got a good, broad selection of individuals on your trustee board so you get diversity of thought? How do you make sure there are opportunities for perhaps different sorts of people to get involved? So think about your governance and admin section, maybe as a bit of a shop window and not just as a recitation of the basic admin process. Finally, I just wanted to touch on record keeping, and I've already mentioned some of the areas where records matter. So firstly, budgets and forecasts. Generally, I would say you want to make sure you've got a budget for income and expenditure, but also you should be doing a budgeted balance sheet and cash flow. The reason for making sure you've got all three of those, as I've already alluded to, is things like grants and provisions don't necessarily coincide in terms of income and expenditure relative to when you recognise them in your accounts. Also, your budgets and forecasts are going to be specifically relevant when you're considering the going concern status of the charity. So you need to think about whether they are complete. And that's especially important if the charity is in a challenging financial position where the trustees need to demonstrate they took appropriate care. Now, two areas where we find we sometimes have to challenge as auditors are firstly, unrealistic top lines, where there hasn't really been enough thought about the uncertainty over the extent or amount of income, especially for charities who rely on fundraising and donations and the reliability of the data there. But also sensitivity analysis. What are the risks around different levels of income? When you're assessing going concern, you need to think about what happens if the income is rather less than you're hoping for. And the other aspect we sometimes find is that the charities sometimes just miss the obvious on their expenditure analysis. For example, salary increases. Have you actually factored in when you expect to do an increase? Have you factored in the recruitment that you are strategically planning to do? Most recently, power costs have been an issue for charities, but inevitably there may be other things as well that you need to just look very carefully at. Second area of record keeping I wanted to mention was the asset history. And the risk here is losing sight of the origin of key assets and the funds that allowed you to acquire them. And that can happen simply through the passage of time, or perhaps because of regime change, especially if you've had long-serving trustees and chief executive, and the impact on corporate memory. So the sort of things you want to make sure you've got good record-keeping disciplines over are things like endowments, restrictions on grants, especially if there is a clawback if you dispose of an asset which was funded by a restricted grant. Local authority transfers, whether there is a need to then transfer things back in the event, for example, again, you dispose of an asset. So it's easy to lose sight of information. As I mentioned earlier, was that reserve really restricted or only designated? How was that major asset funded? So do you retain the records? How do you retain those records? Are they both accessible but also secure? For example, sometimes some sort of SharePoint facility, which is locked down so only senior management and trustees can access it, and it has all the original documents and relevant notes about how they were treated. That's all good stuff. I hope that's been useful and maybe set you thinking about a few things you could do differently. For the time being, thank you very much for listening. And if you do have any particular questions, please contact your usual Francis Clark contact. Thank you.